The trap most will never see. It's unfortunate. This is, and I have a distinct, what I would determine as a perspective with regards to this specific topic. And this is, I would say, the predominant hallmark or principle behind the impetus of the foundation. This is something that I learned. This is a trap that was revealed to me in a particular way, and it was very transformative. The main reason for the foundation is to describe the distinctions between specific structures so that you can make, if you so desire, an informed decision. So I would like to welcome you to the foundation. I am your host, Sot L, Seeker of Truth L, Speaker of Truth L. And I appreciate you taking your time to check out the show. So this episode is The Trap Most Will Never See. And I appreciate you checking this out. Once again, the foundation where we understand incorrect information incorrectly applied can get you hurt. Correct information incorrectly applied can get you hurt. So we are always correctly applying correct information here at the foundation. So let's jump into this. Let's do a dance dizzle. Make sure you check out welcome to thefoundation.com. Sign up for the email list. Por favor. I believe that's please in Spanish. I'm not sure of the pronunciation, but I do respect, all my Spanish speakers. Most, Spanish speakers that I know is bilingual, and just putting most Americans to shame because we only speak one language, but most of us can't make sweeping generalizations. I'm getting off on a tangent. Sign up for the email list. I would say it's most important at this time simply because the things that we're doing, the transitions that we're making, I will get specific on one transition that we're making that will only be available to email subscribers with regards to the initial rollout. We'll say the beta. Getting back in the swing of things. So if you go to welcometothefoundation.com, sign up for the email list. Yep. But when you sign up for the email list, specific and exclusive offers, notifications, events, different write-ups that we do, information, education, so on and so forth. What I will say is soon we will be doing a promotion where we will be doing an interesting, what I would say interesting, or some would say old school with regards to the foundation of Sot L re-edition. And what that is if you look at the platinum over here on this side, you will notice that, on all of these, there is a one-time startup fee as well as a monthly. So what's going to happen is, specifically with this platinum, the startup fee is going to stay the same. This is the beta. Only notified via the email list. I want to be clear. What's going to happen is we're going to add a provision. We already added it. I'm just trying to highlight it. Let me try it this way. There it is. We have this provision, right, where you get my private number, but we're going to have and add the provision where there's going to be a weekly training where you can join. We'll determine if it's going to be a call-in number where you call in with your mobile phone, or if it's going to be a Zoom link. Have it determined, but I will be administering the training weekly. It was something I used to do back in the day. And for a short period of time, and this is why we're talking about the beta, we're going to waive the monthly. And only, I'm not going to say anything about it on the shows. I'm not going to say anything about it on the current events. It's only going to be notified through those who are on the email list. I want to be very clear, because this is more of a thank you to people who are email subscribers, because we don't do ads. I don't monetize videos, where there's no ads on the website. We're just trying to give you and bring quality education that can change your life. So those who are email subscribers will get the offer, the limited time offer, where you will be able to sign up for the platinum and the monthly will be waived. Well, basically that means is it'll be a one-time fee, and it's an indefinite, unlimited, for life kind of deal. It's going to be a limited number of people. And I did this before. It got to be too much. It wasn't structured properly. I had things going on in my life, people passing away and stuff. It was really tough. So it had to be restructured, brought people onto the foundation. I know I'm long-winded, but I want to be clear, as I said. But that's why I'm saying it's a limited time. It's going to be a limited number of people that are going to be able to take advantage of this. It's not going to be everybody that hits the link, even though you are an email subscriber. So we're still working that out. I just want to let y'all know, it was a thought that it was going to only be emailed and I wouldn't make an announcement at all. But I'll make an announcement about the email. That's what was decided. And that will only go to email subscribers. Once again, one time, unlimited. And how it's going to work is how it did last time. We're going to break the training up into sessions. And it's going to go session by session. And you can do as many sessions as you want. One session will be technically the whole manual that we use and supplementals. But a session generally, as I administered training and education of trustees, generally took about 6 months. But, I don't know. You can do as many sessions as you want. But they're going to be live. It's going to be a question and answer after every one of them. You'll also get my private number. There's questions that most people want to ask, and they don't want to ask it in front of a group. So that's the reason for that. And if you get the platinum, you're serious about your private estate. You're serious about setting some up. That's multi-generational, outside of just being serious about legally avoiding taxes. That's just a plus. And people who don't look at that as a plus, they look at it as more of a primary. That's unfortunate. So with that being said, that's the announcement. Maybe I'll announce it again next week, but we're getting it figured out. And that email will go out, I would say, within the next 30 days or so-ish. So appreciate y'all. Appreciate everyone checking out the foundation. Let's check out silver over here on the foundation. Now, remember, there's fluctuations in the market. I just want to be clear. And I'm probably going to do a show on precious metals, or what I call, or what is known as real money. But just real quick, there's fluctuations in the quote market. The way that the market looks at silver and gold is they look at it as a commodity, not as money, even though it is money. It functions as money, but that's besides the point. Now we have either a remonetization or a movement to a whole nother system happening right now. Some people could argue, whatever. But, if you're looking at white papers and statements of the Bank of International Settlements, the World Bank, things of that nature, all of this stuff trickles down to nations, right? So right now, I'm going to say, even at this price right now, silver is very, very affordable. So, dollar cost average, $25, $50, $80, $100 every paycheck, every 2 weeks, every month on a regular, right, schedule. Just go grab some silver. There's fractional silver, a tenth of an ounce, gram, quarter ounce, half ounces. You can, have fun. There's different, bars, there's rounds, coins, there's all types of stuff dancing. They just start accumulating that stuff right now. You will kick yourself if you don't. And, it's not an investment. It's not a get rich quick type of dance. It's as the dollar purchasing power declines, you will protect your wealth and energy in this real money. Just y'all. My mentor put me onto this when it was like $11 an ounce for silver. So just understand what I'm saying, and it's not gonna stop. It's not gonna stop. You're gonna see fluctuations. But long term, fluctuations don't matter. If you're a trader, that's different. But trading physical is very arduous. I wouldn't recommend you do it. But grabbing it, saving a portion of your currency in real money, highly, highly recommended. Highly recommended. So, we got the price of silver at $76.34. It's moving. So it was over 100. And as I said, I began buying when it was between $11 and $13. So, like, seriously buying. Before that, I was like trinkets and stuff for fun. So, let's get into this show. The show, what most people miss, right? I want to talk about the differences in structures. Now, a lot of people, and I'm just going to do the caveat, a lot of people will be dismissive of the things that we talk about here on the foundation just because they are employees or they have a job. And I just want to say that that's unfortunate because that doesn't hinder anything. There's a lot of people that will say, and I've heard many times that, you need to have money to have trust. It's only for wealthy people. And you'll see people in the public. You'll see people maybe even when you go open a trust brokerage account and stuff, they may be expecting some certain type of thing. That's fine. That's fine. I don't care what type of socks you expect me to wear. I'm going to wear the socks you want me to wear. I don't care what type of life you expect me to have. I'm going to have the life that I'm going to have. So, expectations is like, the backsides. Everybody got one, and they're not all that fresh most of the time. You know what I mean? So, if you have a job, don't be discouraged. Please. If you have a good employment, if you have steady employment, if you get along with the people, there's people that say if you're going private, which I guess was a thing and maybe still is a thing, going private. If you're going private, you got to get out 100% out the public. Absolutely false. Absolutely false. Once again, regardless of their expectation of what color socks I wear or kind of socks, I'm going to wear the socks I want to. My socks should not make your feet sweat. You know what I'm saying? So that's the thing. But what we're talking about here is control, right? Privacy and wealth preservation. And under wealth preservation, we obviously have, if the taxation is lower, minuscule, or in some cases negligible, not even happening, then, that preserves wealth in and of itself. Legally avoiding taxes is a wealth preservation strategy. Fixed costs or fixed expenses, these expenses that are expected at all times. So, when you get to talking about legal tax avoidance, it's the tricky part because the obverse or the reverse of legal tax avoidance to the obverse is tax evasion, which is absolutely illegal. And as I don't give legal advice, I can't. I'm not an attorney. I'm not a lawyer. I don't pretend to be. I don't give legal advice. I don't give legal counsel. I can't, never could, never will. I do know the difference between legal and lawful, and I also know the distinctions between tax evasion and tax avoidance. So if you think about wealth as just being currency, Federal Reserve notes, whether they are in a shoebox under your mattress in your house, or they are in a bank account or in a brokerage account or in stocks or whatever. If you see wealth as firmly and predominantly or solely being, these credit instruments or, Federal Reserve notes, then you're missing a lot of the picture, because wealth is also real estate. It's also classic cars. It's also certain types of art, diamonds, gold, silver, things that appreciate in value are also wealth. Land is also wealth. Intellectual property is also wealth. There's a lot of things that represent wealth, right? And when I talk about control, I'm talking about specifically the difference between of control and ownership of all types of wealth between a private trust and an individual. Most people never see that. They never understand that. And unfortunately, it's a thing that, that's happening. And it's happening every day, and it's happening to most people. They don't understand that. They don't understand the implications of that. So the implications are, individuals are at the mercy of the control of the state and control of the federal government. Trusts do not occupy those same positions, do not have those same liabilities. A private trust is not under the control of the state, which is where most litigations arise from. State actions, whether it be probate or any type of civil actions, generally they're going to be at the state level. Now, that's not to say that, a trust cannot be sued, because it can. And there's plenty of case law, specifically Supreme Court case law, that shows that and proves that trusts can be sued and they can lose. But if a trust is just holding assets, holding wealth, and has no dealings, i.e. no contracts with no one living or no body corporation in the public persons, then there is no standing for any one person living or any body, person, corporation to pursue or to sue a private trust. And that's for the life of the trust, which is not perpetual, because perpetuity only exists for corporations. Truly, it's not natural. Trusts generally are renewed. So when it comes to credits and deductions for individuals, this is not the first time I've got into this, but I feel like every time I get into it, I kick it kind of differently. And, I get feedback that most people appreciate that. If you appreciate that, you can leave a comment. If you don't, leave a comment. I like the feedback. This is for y'all. These are the deductions, right? You got standard deductions versus itemized, right? Standard, there's a ceiling. There's a ceiling of deductions, man. Itemized deductions, there's obviously a specific allowance for deductible expenses. And they're very specific, right? Alimony payments. You have to have been married and divorced, and your spouse not be remarried and be ordered by the state courts. Remember I said state courts. To pay alimony because of that state contract, which is a what? Marriage license. And the status of individuals. But I'm not going to get into that. I'm not going to get into the status. We're talking about standing, right? To pursue a private trust and the allowable expenses for a private trust versus an individual. Business use of a car. You have to own a business, right? So there's a benefit for owning the business, even if you were an employee. There's one right there. Business use of her home. You should own a business. Hey, listen, money put in the IRA, that's an individual retirement account. That is what generally a retirement account set up by an individual, which is generally tax deductible or non-tax, because most IRAs, the disbursements are taxed, meaning there's a tax when you grab the bread, unless you have a Roth IRA, which you pay taxes before you put it in there. I'm not a lawyer, accountant. I could be crazy, y'all. I could just be reading stuff from what I wrote down with crayon when I lost it that time in December. Who knows, man? I'm not a lawyer, y'all, is what I'm saying. No liability on me. I might be crazy, y'all. They hear that. Listen, the man said he might be crazy. Why'd you even? I'm just saying, do your own research. I recommend that you do your own research, because it's another thing when you hear it. It's another thing when you read it and you comprehend it on your own. Like, hold on, wait, what? Wait a minute. What do you got? Money that you put in a health savings account, or HSA. It's a deduction. Most people have, insurance from their job, or maybe some sort of state insurance, or some insurance that they bought in the open market. They get deductibles, but usually if you have a business, it's income that the business can basically pay you, that you can put in an HSA, and you get certain deductibles. You see, penalties on early withdrawals from savings. You can deduct the penalties. So sometimes the wealthy withdraw early. Obviously, student loan interest. You got to be a student and have student loans and not be in school, because I think 6 months after you're not in school, then you have to start paying your student loans. And teacher expenses. You have to be a teacher. Very specific. If you itemize, you can deduct bad debts, canceled debts on homes, capital losses, donations to charity, gains from sale of your home, gambling losses. You got to gamble. You have to sell a home. You have to donate to charity. You have to have capital losses, which is like losses from investments, securities and stocks and stuff. Canceled debt on the home, so, had a foreclosure or some sort of discharge. Have to pay mortgage interest, so if you rent, you don't get that. Income, sales, real estate, and personal property taxes. So some income taxes, some sales tax, some real estate tax, and some personal property tax. So I think renters, like there's a renter's credit or something. It's like a credit for the portion that they give you credit for, that they expected that you paid on the interest of the mortgage of the owner. I think that's how it works out. Medical and dental expenses. So you have to pay out of your pocket for your own stuff. And that's over 7.5% of your adjusted gross income. It's very specific. And then some miscellaneous itemized deductions. And then you have, lastly, opportunity zone investment. I mean, you have to have invested in an opportunity zone. We're talking about keeping more that we make in order that we can do some of these things, obviously, to allow for these deductions, right? Trusts and taxes. We're at Fidelity. This isn't me. I didn't create this corporation. But I want to go to this. From a tax perspective, trusts assets are generally classified as either principal or income. So principal is not taxed. That's trust assets. So it's like them trying to roll up on me and like, hey, we need a tax on your car that you bought, 5 years ago. I'm like, man, I already paid taxes. Like, what? You ain't finna tax me. This is my principal, man. Then you have income. That's stuff that you're generating. That's stuff you're getting over time. Like, every week or every month or whatever. You be getting money, basically. That's the income. But income is very, very, very specific. And I would say that income is not what most people think it is. But if you claim that it's income, then, hey, what you say can and will be used against you. Generally, the assets the trust owns represent the principal. And what those assets earn or produce represents its income. So the money you make off your real estate, if you have a property that you rent, the money you make off of the stocks that you're holding, or the trust is holding specifically interest payments or dividends. For income tax purposes, a trust is treated either as a grantor or non-grantor trust. This is specific. Private trusts just in common law trust, Massachusetts trust, business trust, these types of trusts are always non-grantor trust, non-grantor. And if they're not, they're weird, and I don't want to deal with them. They're weird because a non-grantor trust is a grantor trust, and a grantor trust is not a separate and distinct entity from its creator. And those are alter egos. They are set aside in most litigations, tax suits, probate hearings, all that. It's not what we're looking for. When we're talking about maintaining and keeping more that we make and keeping and maintaining our wealth, not under the subjugation of the state, state probates, state tax authorities, things of that nature. A revocable living trust allows the grantor to transfer. We're done. You know what? We're done. Y'all, look, I'll give you some time. I'm going to keep talking. Y'all can read that if you want. But that's all I needed to read. Hands down. An IDGT gives the grantor some we're done. Gives the grantor some control. We're done there. It's over. Nope. None of that. For non-grantor trust. Okay, now we're talking. Who is responsible for paying income tax depends on whether the trust is considered simple or complex. Complex, we're going to say it. Non-grantor, complex. These are private trusts. Also known as irrevocable complex trusts. Irrevocable complex trust. And this is like, these specific terms when dealing with certain agencies and those acting on behalf of those agencies, the letters and stuff. Irrevocable is important. Irrevocable means the grantor can't come back and change anything. They can't do anything. Once they create the trust and the trustee sign, it's over. And people will scare people off. Like, that's how you lose your control of everything. They can take everything away from you. But then they don't understand why it's called trustee training and not grantor training. It goes over most people's heads. It's cool though, because not everything is for everyone. A simple trust, we're done. A complex trust, there we go, is one that is not a simple trust. In other words, a trustee has more discretion relating to the distributions of income and principal. Although the trust may provide for mandatory distributions of some or all of its income and principal. The trust may provide. You hear that? The trust may provide, not law, not statute. The trust may provide, the contract. This is the power, y'all. In case of a simple non-grantor trust, we're done. While the maximum rates. Oh, wait. We almost lost out. We almost lost because I know what I'm doing, but sometimes I don't. For complex non-grantor trust, the tax may be paid by the beneficiaries, the trust itself, or a combination, depending on the circumstances in any given year. Broad powers, very flexible, very, very flexible. And that flexibility allows for some very distinct benefits. While the maximum tax rates are the same for a trust and an individual, that's the maximum. Trusts are taxed more aggressively than individuals. And that's cool. And I'll concede to that. That's absolutely right, y'all. That's absolutely right. But without training, you don't understand how that is an absolute benefit. A distribution to a trust's beneficiary could result in a lower overall tax. That's absolutely correct. A complex trust can donate 100% of its tax liability to a charity and receive a charitable deduction, or it can disperse 100% of its taxable income and therefore owe no tax. A complex trust. And then what happens if the beneficiary or beneficiaries of this complex trust that is dispersing its taxable income to, and the reason why it's dispersing its taxable income because it has taken its allowable expenses according to the contract indenture, and the Board of Trustees had made a determination. They don't have to. This is a private trust. They don't have to make a disbursement to the beneficiaries, contrary to what most people believe. Because most people either want to be a grantor or they want to be a beneficiary. Why do you think it's called trustee training? That may be the case because the trust will take a deduction for the distribution, and given the higher threshold for individual filers, depending on the beneficiary's overall income level, and beneficiaries can be individuals, beneficiaries can be corporations, and beneficiaries can be other trusts. Now, I would never recommend a private trust beneficiary be a corporation. That's ridiculous. Why you mix public and private like that? Come on, get out of here. Why would you do that? But I'm just making a point. The beneficiary may be in a lower tax bracket. Important considerations, choice of trustee, investment management, conclusion. This is fidelity. Let me move on, because what expenses can be paid from an irrevocable trust? I think this is amazing. What? Beneficiary support? What? Many irrevocable trusts are established specifically to provide beneficiaries' needs, or provide for beneficiaries' needs. The trust document typically outlines the extent to which beneficiary expenses can be covered. These might include direct payments for health, education, maintenance, and support, often referred to as HEMS. It's different. It's fiscal. I don't remember. Food, clothing, shelter, education, healthcare, retirement services. But hey, they're saying it's HEMS. I like that. Health-related expenses can encompass medical insurance, premiums, deductibles, co-pays, prescription, medication, and treatments not covered by insurance. Some trusts may also cover alternative therapies, mental health services, and long-term care expenses. Education expenses typically include tuition, books, supplies, room and board, and sometimes additional educational opportunities like study abroad programs and professional certifications. Maintenance and support payments can cover living expenses like housing costs, mortgage or rent payments, utilities, food, clothing, and transportation. The interpretation of maintenance and support varies depending on the trust language and can be influenced by the beneficiary's accustomed standard of living. Property expenses, tax obligations, irrevocable trusts. I mean, listen, this is from Zeus Estate Planning. Y'all can look this up, man. Here, let me go to this is the title. What expenses can be paid from an irrevocable trust? This is Stefan Resnick. This is an attorney, y'all. I get to talking and they be like, "Are you an attorney?" And I'd be like, "No, I would never do that." They just look at me with disgust. And from then on, the stuff I say doesn't matter. And I'll be like, "Cool, I don't want to deal with you anyways. It's too bad. I would have loved to have helped you and your progeny." Hold on, where am I at? Property expenses. When an irrevocable trust holds real property among its assets, it must be titled in the trust name. Related expenses can be paid from the trust. These include property taxes, which must be paid to maintain the property's good standing with local tax authorities. This is an expense to the trust. The trust writes this off. Insurance premiums to protect the property against damage, liability claims, and other risks are also legitimate expenses. Like security systems, doing a new driveway. Maintenance and repair costs necessary to preserve the property's value and functionality can be covered by the trust. This may include routine maintenance like lawn care and cleaning services, as well as repairs to address damage or deterioration. Utility bills associated with the trust-owned properties, including electricity, water, gas, internet, and phone services, can also be paid from trust funds. It's a write-off. For income-producing properties, additional expenses such as property management fees, advertising costs, and for attracting tenants and other operating expenses can be legitimate trust expenditures if they support the trust investment objectives. We got tax obligations. Must fulfill various tax obligations. These are irrevocable trusts, which can be paid directly from trust assets. Income taxes on trust earnings are a primary expense. Irrevocable trusts are generally taxed as separate entities. Exactly. There we go. Although some trusts may be structured as grantor trusts. You see why we because this is what we're looking for. And the reason why, and that's what I pointed out, the specific deductions for individuals, it's very limited. It's very limited. You see all this stuff there is for trust, right? It's very flexible. It's elastic. Property taxes on trust-owned real estate are legitimate expenses, as are any estate or inheritance taxes that may be applicable depending on the trust provisions and state laws. Private trusts do not come under state laws. It's only about the provisions, the trust document. The trust document serves as its primary guide for determining what expenses can be paid. The language of the trust instrument specifically outlines the permissible uses of trust funds. Now, I want to say this, right? Private trusts, the trustees hold a board of trustee meeting, proposal, resolution, it's a part of the trust. It's the same way how the Constitution for the United States of America has amendments, because the Constitution is essentially a trust. There is grantors, there's trustees, and there's beneficiaries. Straight up, read the Constitution. The Congress is the trustees. I'm just going to say that. And Congress can amend the trust. They have. There's a lot of amendments. There's over 14. There's 14 I focus on. I focus on 14. I focus on 14. You should too. You should too. Focus on 14 is very freeing once the focus is focalized. Let me quit playing with y'all. But I'm not joking. I play a lot, but I'm not joking. The trust document serves distribution standards set forth in the trust document, such as necessary, reasonable, or appropriate, influence what expenses qualify for payment. Trustees must adhere to these standards when evaluating expense requests. Trustees' discretion and fiduciary duties. Let's get into these tax expense or tax implications of trusts. Expenses paid from an irrevocable trust can have significant tax consequences that must be carefully considered. When a trust makes distributions, okay, so this would be the trustees issuing a check or handing cash to the beneficiary. So a check in the name of the beneficiary or handing cash straight to the beneficiary. For the benefit of beneficiaries, these distributions may carry out taxable income to the beneficiaries under the principle of distributable net income, or DNI. And this is what I said earlier. A trust can disperse or distribute 100% of its taxable liability or taxable income to its beneficiaries and therefore owe no tax. You know, it legally avoided taxes. It's that simple. That's just one of the ways it does it. This means the beneficiary, rather than the trust, may be responsible for paying income tax on these amounts. Certain types of distributions might trigger gift tax consequences if they benefit individuals. If they benefit individuals who are not named as beneficiaries of the trust. For example, if a trust pays a college tuition for a beneficiary's child who is not named as a beneficiary, this could potentially be considered as taxable gift from the trust beneficiary. Listen. If it was me, I'd be like, where do I sign up, brother? You know, if it was me, I'd be like, shut up, man. Where do I sign up? Because I get it. But maybe, you know, it takes more. It takes more. It takes more. How can I receive living expenses from an irrevocable trust as a grantor? This is for all my elders, all my aunties, all my uncles, you know, my grandpas, my grandmas, you know what I'm saying? Gram, big mama, you know, pops. This is for y'all, you know, all my elders, you know, all my elders with wealth, all my elders that have a house that's paid off or about to be paid off, or you got one of your family members who's an elder. All my elders and all my peoples, my brothers and sisters who love an elder or have elders in their life that they love. This is for y'all. This is for y'all, and this is out of love because I love y'all, man. The human family, we're all brothers and sisters. I know it's corny. I know it sounds corny. We've been trained to think this stuff is corny, but it's so true. We're all one family, man. Straight up. Man, how many times have you seen just a stranger laughing and it made you at least smile? Because you saw someone laughing. You didn't even know that person. This stuff has effects. So this is me spreading love intentionally. And I do it through knowledge and information and education. As the grantor of an irrevocable trust, you generally give up control over assets once they're transferred into it. Because of this, the trust typically cannot pay your living expenses directly. However, there are limited scenarios where you might still benefit. Remember? Hold on. Let's go back to this. The trust typically, that's a qualifying word, typically cannot pay your living expenses directly. Both of these words, typically and directly, I want you to pay specific attention to those words and what those mean and how they modify that sentence structure. And I'm not playing, and I'm not trying to be your English teacher. I'm dead serious. This is for comprehension. However, there are limited scenarios where you might still benefit, such as if the trust was structured with certain retained rights before it was finalized, or if distributions. We're gonna ignore this one. Grantor should never retain rights. No. Or if distributions are allowed for your benefit under the original terms. Check it out, y'all. Otherwise, those funds are considered outside your reach and reserved for beneficiaries. What is an irrevocable trust? We talked about that. The grantor cannot revoke. The grantor has no more power. If the grantor's house is in it, the trustees can kick the grantor out of their own house. It's not your house. It belongs to the trust. The trustees are responsible for the trust property. They probably want to monetize it and be proper fiduciaries on behalf of the trust. You made a bad decision by, granting your property to trustees who are more interested in doing their job, and their fiduciary duty than being your friend or your family or whatever. It is what it is. It's a character thing. So no grantor. There's a grantor gone out of here. Doesn't have anything to do with it, but they granted it. You got trustees. You got beneficiaries. Benefits of an irrevocable trust. Medicaid. Let's check this out, y'all. All state Medicaid programs have some form of poverty requirement. Your household's assets and income must be below the program's threshold in order to enroll. This is when you get older. Medicaid. Many households that need Medicaid coverage, particularly its long-term and residential care programs, are too wealthy to qualify. An irrevocable trust can allow you to reduce your household assets while also controlling who receives them. You'll want to plan ahead with this strategy. However, as Medicaid has a 5-year look-back period on assets. So 5 years before you want to qualify in Medicaid, put your children as trustees and grant the trust and title the house in the name of the trust. Grant the, boom. So you don't own it. You qualify for Medicaid and you still live in your house, man. Now, remember, when it comes to your children, it's a character question. So not all children can be fiduciaries. Not everyone in the family is going to be a trustee. It's not for everybody. I had crackhead Uncle Larry. We couldn't, Uncle Larry couldn't be. No way. No. Estate planning. In most cases, a revocable trust will work equally well. We don't want to hear that. We don't want to hear it. Debt collection. I like that. In extreme cases, an irrevocable trust can sometimes shield your assets from creditors. Sometimes. Most times, if you do it right, it has to be, there's a look back period because an individual is subject to state law, statutory law. There's a state birth certificate. That's the originating document of the individual. Straight up. So it falls under state regulation. So, you got to do it. It's estate planning. You have to do the planning prior to it being necessary. This is the benefit. In extreme cases, shield your assets from creditors. Once you transfer assets into a trust, they are owned by this legal third party. Creditors cannot reach into the trust and collect those assets simply because of the association with you. You lose the assets, but you get to choose who gets them, the trust. Although, be careful about this approach. Courts look disfavorably on parties that try to evade debt collection. So it has to be done before, basically bottom line, just do it when all your payments are up to date, and you can't do it and 6 months later, stop paying stuff. It's not going to work. There's a look back period. It has to be, it's estate planning. So I hope you see the benefits. Food, clothing, shelter, education, healthcare, retirement services. Allowable expenses to the trust, write-offs. I don't give legal advice. I'm not a tax attorney, but I've been operating the trust for and you can go back, you can listen, you can check out the channel, check out the YouTube, go through the history, and keep clicking load or load more. Keep going, go all the way down, and see how long I've been doing this. And I didn't take a break. I didn't go to the Fed for tax anything, and then get out and try to reboot the. Nah, listen. If you want to know how to do a thing, learn it from someone who's doing it. You know what I'm saying? And that's what's happening at the foundation. And these are things that you can do. These are things that you can offer to your family members. This is stuff that you can get set up. And those who know will know and will benefit from it. And those who don't, well, you can take care of them because you got your stuff set up. I always tell people, trustees, and then private clients outside of the foundation, because, I got to dance outside the foundation. I don't care how much you made. I don't care how much you made. Respectfully, with all due respect, I do not care how much you made. My job is to be concerned with how much you keep. Because that's where we're lacking. That's where we're not paying attention to, and that's where we lose. Almost every time. Almost every time. So there it is, the trap most will never see. Most will never see it. It's the difference between the structures that we're using. Everybody thinks they're an individual. You're not. You're administering an individual. It's paperwork. I'm sorry to say it, but it's as simple, concise, constructive, and honest as I can say it. But the administration the administration of the individual is the worst tax spot to be in. And most liability heavy spot to be in. And even if you have a job, you will benefit by creating a private estate, business trust, asset trust, family trust. I promise. If you utilize it, if you learn it and you implement it and you work it, you will benefit. And when you benefit, you'll work it more and you'll benefit more. And you benefit more, you work it more. And it's just a cycle that picks up. And it's pretty cool. And your life changes. And then you call me and you say it and you tell me how your life is changing and I tell you, just let it be normal. Just let it be normal. You deserve it. You did the work. And some people it's too good to be true. I know. Sounds too good to be true, or it's too expensive, or I can't afford it. There's a lot of excuses. There's a lot of reasons. There's a lot of distractions, and there's a lot of hurdles. But, I think you deserve it, and I know your children deserve it. I know your parents deserve it. I know the people that you love deserve it. And I know that they deserve to be a little less freaked out and a little less anxious if something goes wrong. I've been through it. I know people have been through it. And everything's cool, as we all know, until it isn't. Tomorrow's not guaranteed. And sometimes it just feels good to be responsible. Sometimes that's what we're missing. That's what we need is I need to do something that's responsible so I can feel good. Like at least I got this taken care of. There's so many things that we think about that we can worry about and that can cause, anxiety, that can cause disharmony. But we got to start doing things that we can think about that can cancel that out, that can make us feel good. And I'm telling you, getting your stuff set up in trust, knowing that if anything happens to you, it's not going to have to go to court or nothing. There's other trustees, there's successor trustees. They have the proper paperwork. They just go take over the account. They just start driving the car. They just keep staying in the house. They don't have to go to a probate court for 2-3 years and deal with that stuff while dealing with the loss. And there's way more benefits than that, but you have to be structured properly. I could talk about private family foundations all day. I could talk about private banking through whole life insurance policies all day. All day. But that's just me. That's my rant, y'all. I appreciate y'all. Y'all take care of yourself. Enjoy yourself. Make sure you say 10 things that you're thankful for before you go to sleep tonight and every night. And I will catch you tomorrow on current events, y'all. Peace.